Japan's fiscal warning siren began with a single sentence in parliament. Prime Minister Shigeru Ishiba told lawmakers that the nation's finances are now worse than Greece. That stark declaration landed on May 19, 2025. The same week, traders drove the yield on Japan's 40-year government bond to 3.6%, a level unseen for 2 decades, before closing their terminals in sudden silence. The numbers behind this drama are sharp and sobering. Japan's economy contracted 0.2% in the first quarter, marking its second consecutive quarterly decline and signaling a growing risk of recession. Its debt already towers at roughly 252% of GDP, the highest among advanced economies and more than double Greece's ratio at the height of its crisis. Nearly 30% of Japan's population is now over 65, swelling pension costs and shrinking the tax base just when every yen is needed. Yet Japan's debt story is unique. Unlike Greece, most of Japan's borrowing is held domestically by its own citizens and institutions, whose deep savings have long financed the government's spending. This provides a cushion, but also means Japan's shrinking economy hits even harder on its ability to service debt. Ordinarily, these facts might rattle only Tokyo, but Japan is also the world's largest foreign lender to the United States, holding $1.13 trillion worth of U.S. treasuries as of March. If Japanese institutions start selling even a fraction of that stockpile to defend their own budget, Washington will feel the quake. America is already wobbling. On May 16, Moody stripped the United States of its last AAA credit rating, citing unsustainable debt dynamics and growing political gridlock. This downgrade, a rare and serious blow to U.S. financial standing, sent shockwaves through global markets. Within hours, the 30-year Treasury yield vaulted past 5%, a height last seen before the 2008 financial crisis. The national debt now stands near $36.6 trillion and keeps climbing by roughly $1 trillion every 100 days. Meanwhile, Capitol Hill is debating a bill, nicknamed the Big Beautiful Extension, that would make the 2017 tax cuts permanent, potentially adding $2.5 to $5.3 trillion more to the federal deficit over the next decade. Picture this: Japan's bond yields ticking steadily upward, U.S. yields following suit, the dollar slipping, and safe haven gold rallying in response. Each move feeds the next, knitting the world's 2 largest debtor nations into a fragile, interconnected system. When confidence breaks, capital doesn't argue, it simply leaves. That was the lesson from Greece 15 years ago, and it is the warning Prime Minister Ishiba has just delivered. The next tremor may start on the Tokyo Stock Exchange, reverberate along the Potomac, and ring every smartphone on Earth. This is no distant headline, it's a real-time, evolving story told through 40-year Japanese bonds at 3.6%, U.S. 30-year bonds skimming 5%, a 252% debt ratio in Tokyo, and a $36.6 trillion IOU in Washington. Beneath it all, millions of investors hold the power to move trillions with a single click. Stay alert! Subscribe so you don't miss the aftershocks, because this story is still unfolding, and the final chapter will be written in bond prices long before it hits the headlines.